Hey, good morning, Vivek.
Hey, morning, Jay. How are you?
Good, good. Happy weekend. Happy Saturday.
You too, man. Thank you for joining in every Saturday. All right. So, I guess let's make sure you guys able to see the document.
Vivek,
Yeah.
this is a non-investing question, but how do I need to prepare for Trump going to office? Because I wasn't here the first time.
Uh, I just take it every day basis. I don't think I have an answer for that. So, yeah, nobody knows what's gonna happen in future. So I just don't worry much about it. Anyway. So, shall we get started? I'm just checking. There are a few things that I want to cover today. Um, last time we talked about, I think someone of you mentioned Carvana had a short report. So I spent some time in going through the short report. Uh, you guys know I love short reports more than I love the long reports. Uh, you know, that's just me. It's fun to go through the short reports. So I'll give you, a quick overview of that report. And then I also thought I'll talk about, I think there are a few questions that were outstanding from our previous meeting. There are some backlogs that I would want to cover. Stuff like, I think we missed talking about, what are some of the things that I look for a quality business, right? When I'm looking for investing in a business. So that's like very basic. To start the year on a good note, I thought we'll do that. So we'll cover that. I think there were a couple of questions. I was going through the chat yesterday and even today morning. I saw some of the questions that I don't think I answered it in a previous meeting. So we'll go through that. There are some charts for you guys, and what else? Yeah, that's pretty much it. So we can talk about that. I see a question from Jay saying BITO ETF, looking at the massive dividend and crypto. What I think about that? BITO. So BITO it's not a spot Bitcoin ETF, right? Or is it? Am I mistaken? Is that a futures ETF or is it a spot Bitcoin ETF, Jay?
Yeah, I think it's futures. Yeah.
So this one is based on futures. Does it has a dividend? A dividend yield of 57.95. So
Massive dividend. I'm just like,
hold on.
what does it qualify to? They give so much. I'm sure there's a lot of volatility behind it.
No, no. So there are many of. Okay, so let me just pull this out.
It's probably per year on that dividend.
Yeah. So first is expense ratio is 0.95. It's a very, very expensive one. And this is what? Is it the same as the one that basically provides a dividend through the call selling? What does it profile says? The only reason why it can give this 59% dividend is if they are basically selling call against um, you know, the holdings. So there is no, and let's go. So anytime when I see these expensive or very high dividend, I want to compare the overall return of my investments, right? So which is basically dividend plus your capital appreciation. So if I really look at a bidder and I go for, let's say, last 3 years, right? In a 3 years, it's been, but do so it started here and it's barely moved in 3 years.
Yeah, yeah. I haven't seen it much. I mean, somebody touted it as a big dividend play. I'm like, let's
Yeah,
take.
so there are many of these. These are yield max ETFs. There are these calls ETF. There are now ETFs on a single stock, which will
Mhm.
give you these earnings, right? So if you are someone who just want to have consistent earnings in form of a dividend. So these are how they generate the dividends, basically by selling calls against it. And I mean, we have gone through in previous sessions in terms of very detailed of how they take a synthetic long and then generate a consistent income against it. But then, dude, he didn't make any money on the capital side. And if we really look at how the Bitcoin itself has performed over 3 years, we don't have to talk about it. We know how the Bitcoin has done, right? So that's what you need to look at. And other thing is the tax consideration. Many of these are non-qualified income. So the tax may be, so basically the dividend income could become your normal income rather than a qualified dividend income. So these are the other things. Morning, Aditya. Would you love to know your thoughts on sensible investing things to do in a tax season plus new investing year, relatively new to the country? So I think that if someone who is new and still trying to figure out what am I supposed to do while I learn about this country, or while I learn about this whole investing stuff, I think the best thing we can do is, until we try to figure out everything in the kitchen sink, just pick S&P. In fact, I was looking at some data, and I'll share that in the meeting, is around how majority, when I say majority, is like really more than 60, 70, 80% of the fund managers just can't beat passive investing. So while you're trying to figure out which businesses, etc., just pick S&P 500, the very low cost ETF, and learn with that. You can't go wrong with that.
Wonderful. Thank you, Vivek. And just in terms of, if there are any sort of tax-friendly limits, IRAs, etc., that we can max out beginning of the tax year to improve longer-term returns.
Yeah, so I'm not a tax attorney, so let's get that disclaimer out. But
Okay.
one should always invest. I mean, me personally, if you can, you should always max out our retirement stuff, right? So it's a 401k. If you have 401k, and we should put the max limit of 401k. I think in this year it was 23,000. We should be able to do that and put the money for retirement. And in fact, I was sharing one chart. Let me bring that up with my some family friends on WhatsApp. So come on, I can't get rid of that. So basically around the power of compounding, right? And maybe I'll share it next time, but it blows their mind. If you started investing, and I actually sent that chat in our family friend group saying, gosh, I should have known these things when I was in 20s, but it's never too late. So if you started investing $5,000 when you are 25, and you did it for 10 years, from 25 to 35, right? And you didn't invest anything else after that. Versus if you started investing $5,000 when you were 35 and did all the way to retirement. Retirement it is 65. You would have made a lot more money when you started from 25 and did only for first 10 years and didn't do anything. I mean, that blows the mind, because that's what the power of compounding does, starting early. So if you're young, start early. Doesn't matter what's the amount, we should just start early. And I've been guilty of starting late because I don't know, I can't figure it out, I don't have a time and all that stuff. Geez, I should have known these things way before.
Yeah.
Zaina said, how do people know about the stock that will be moving that day? It seems like everyone knows, and soon after the market opens. I don't even care about it. I don't think anyone knows what's going to happen, Zaina. But in hindsight, half of the people will turn out to be right because they were on the right side of the trade, and half of them will turn out to be wrong. And then you will see, everyone coming and talking about why they are right and the others are wrong. So I don't know. There are so Alfred says set up scanners and TOS or other trading platforms. Yeah, you could do that. Trying to look at a second level data, if your trading platform provides it, which will tell you, which is buying, what's selling is happening. But one day is just a noise. I don't care about what's happening on one day, and that's just not me. Fred says this year we are able to do 47K with a catch up and a new Roth, so about 3950. And if you are owning a small business, you can actually do a lot more. I think up to what, 60 or something. That's what, in US, if you are a business owner, you have a lot more tax friendly environment in out here. Ramesh says always invest percent to get company match and possible go to the max also after tax money in 401k. If the income limit by IRS allow, one can still invest in Roth or traditional IRA. Okay, so we are getting to the tax side, but yeah, I agree. I mean, my intent would always be to just max out whether you get a match or not. I've never worked in a companies where I ever had a match, but again, the idea is, hey, let's max it out. And the second thing is around, yeah, Roth is a good idea. And one thing which not many people know, I did not know in my first job, but many companies. So even if your income is higher and you can't invest in Roth because you're beyond that income limit, but sometimes your 401k provider through your company itself, you have a regular 401k or you have a Roth 401k option. So I have used that while working in a company, to invest some in my Roth 401k. And then when I left the job, I converted that to Roth IRA. So something that you can talk to your HR and see if your company offers Roth or not, right? All right. Okay. There are a few sections I have no idea. uh,
So Vivek, you converted your IRA to Roth, meaning you paid taxes on that one. I
no,
mean,
no. So, in some of your in your company
yeah,
itself, you can have your regular 401k, what's called traditional 401k, or some companies might offer your Roth 401k.
Roth 401k. Okay.
So my company was offering, one of the companies I work for, they in fact had an option for Roth 401k.
Got it.
Right. So
Hey,
yeah,
Vivek,
no.
can you hear me? Are you
Yeah.
able to hear me?
Yeah.
So basically, the last 2 years, a new law got into effect, and everyone in the United States, they have to comply by 2026, the new WAF law. So based on your income, if you're doing a catch-up, you can do a catch-up anytime after you're 50 years old. I mean, I tell my friends, you can do it now. You don't have to retire. You can put your money way ahead if you can, the maximum. So a catch-up is if someone did not put all the money every year in the company. So I didn't put any money into Roth IRA. So I had a catch-up of $60,000. That means that every year I could put $20,000 additional leading in before. So when you announce a catch-up for this year's, the new catch-up is $47,000. That's only if you're announcing that you're going to retire. You have to go to HR, says, I'm going to do a catch-up. They'll enable that function for you. So then you will have 401k. I'm in state and city, so it's the 47, not 401k, but same thing. So what happened? You have two choices now. You can go half, partial, or you can go all in on the new Roth 47, which is after tax. That means all your earnings for life is tax free. So you have a choice to decide if you want to pay my taxes now or should I pay my taxes later in life. So most of my friends who are smart who already have the house paid off, we took the 47 Roth, which is after tax, and then all earnings tax free for life. So those are the new two laws, and you actually forced. The new law says if you're making more than I think $145,000, you must select the 457 the 401k off is because the government needs more tax money right now. So the way for the government to get the money now is forcing everyone who's making more than 145k for the catch up to get their 401k off. So they get taxes right off the bat instead of waiting for them to get the taxes when you're 75 or after in life. So this is the new law that got changed. Just to give you guys catch up what's happening in the last 2 years. The 2 years, okay?
Cool. No, thank you, Alfred, for sharing it. I think, yeah, so if you're interested, talk to your HR admin, plan administrator, or your CPA to figure out all these new Roth catch-up contributions and be able to save almost 47K. Yeah, I did not know. I've been not in a corporate job for the whole this year, so I don't know what got changed, but it's a good information. Go ahead and check with your plan admin. Cool. All right. Shall we get into today's discussion? I'm just checking any other questions. Wow, we moved into the tax discussion. That wasn't on my bingo card. All right. But it's all good as long as we can figure out how to save money or make money, right? That's what we're here for. Cool. All right. So let's talk about today's session. As always, anything that we discuss here is only for education or entertainment. Please don't consider anything as a tax advice. We just talked about some taxation stuff or financial or investment advice, guys. Everyone's situation is different, and you have to figure out what works best for you. We'll talk about stocks. We'll talk about different ways of investing, but don't just go and trade based on whatever you hear out here. Okay. All right. So let's look at the high level. Okay. So these were. We'll go talk about that later. Let's talk a little bit on the market this week. I think pretty. I would say we had a pretty exciting week. We had a couple of reports, and market was zigzagging, and eventually net. I think short-term basis, this week basis, not the greatest week, to start the year, but who cares? I mean, we have had a good run. So we had two data coming out. We had a labor market that came out on Friday, and inflation, was it earlier this week or last week? See, if you really look at it, these 2 months or 2 quarters later, we won't even be talking about it. These are just things that happen on that week. Doesn't really matter in a long term if you're buying a good businesses. But anyway, so we had a labor report came out, and now we are back to phase where is good news is bad news for the stock market. Right? If you are new to investing or new to figure, listening to what's happening in the markets, you might be surprised. The labor report was pretty strong. We had more jobs that got added into the economy than what the economists were predicting, and the unemployment rate was lower than what the predictions were. That's great. More people at work. Companies are able to hire more people. It means companies are growing, their business is growing, companies probably are making more profit. Good for economy, good for folks who are working. But then the stock market didn't like it, and that's a dichotomy or dilemma. Someone new starts thinking, what the heck? When the things are going good, why the market doesn't like it? Because market has got addicted to the dope from Fed, which is lower rate cuts. And if the economy is strong, labor market is strong, Fed, central bank, then they will be less willing to reduce the Fed rates. And I remember, was it 2023 where we started with 7 rate cuts? We thought we'll get 7 rate cuts, or was it 2024? So we started one of those years thinking that we will get 7 rate cuts. We got only 2 or 3. Maybe I think it was 2024. And then now this year, 2025, at the end of 2024 or start of 2025, market was pricing in maybe we will get 3 rate cuts. And now the last week we thought maybe we'll get 2 rate cuts. And now the latest report from BOFA, Bank of America, says probably no rate cuts this year. And if as a market, that's got addicted to the rate cuts coming from the Fed, and now the possibility or probability of getting rate cuts is coming down, then that's not good. So BFA report came out later, but I think overall the market is still expecting maybe just one rate cut, which probably might happen during, in April, sorry, in July. So after June meeting, market is pricing in, and you can go and look at the data on Fed Watch tool. Market is pricing in, maybe we will just get one rate cut. And that means, and that's what the market didn't like it. So we saw the weakness in the market. Market sold off on this news, especially the companies that are not making money right now, but are making money way later in future. They get more impacted by the higher rate cuts because of how they try to calculate what's the current value, and that's what we saw in the market. But I'm just wondering if you have invested in a good company that doesn't need the generosity of the Fed, do you really care about these things? These might come out as an opportunity to add some of those great companies, because when market goes crazy, we'll throw the baby with the bathwater, right? So we have seen it many times when this happens. I'm not saying that right now it's an opportunity to get in or not, but if you own good businesses, we don't have to worry about what's happening in the rate cut, what's happening to inflation, especially if you have a long horizon. If you're trying to day trade, or maybe do a weekly base or monthly base, short term, then yes, you have to worry about it. I looked at the data of whole 2024 on every day basis. 55% of the time we had up days, 45% we had a down days. So you had a 40, if you're trying to do a day trade, there are 45% chance, that you could have lost money, unless you switch to the short sides. So, and nobody is that lucky. So, but market doesn't predict well if you had just, stayed long for 2024. So I really do not pay too much, attention or change my investing thesis based on, what's happening on inflation, what's happening to rates. These things does impact for a shorter period of time, but then the good companies, good management will get adjusted to it. If anything that the markets have told us in last few years is this is what I've learned. When I started investing in US market, rates were almost very low, much lower than what we have today, and the whole chatter in the market, if the rate's gonna go high, stock market will crash. And yeah, it did. 2022 it did. Then what happened? Companies learned. Now there is not it's always a change, which I believe that causes concern. Once you know that this is what the future is gonna be, we will adjust. For human beings, change is the only permanent thing, and then we'll figure out, okay, Mr. Fed, you're telling me it's going to be 4%. Yeah, as a CEO, I'll figure out. As a CFO, I'll figure out how I need to run my business. Just that you make a change now, that's caused a little bit concern for me for a few quarters, because I have to change my operations. I have to, become lean, mean, and thin. We need to cut cost. We need to figure out how to do financing. Yeah, it'll take me a year, 2 years to figure that out. Then I'll live with it. So if you have only outlook for a year or two, that's what then we really need to figure out, and that time the portfolio will definitely get impacted by the short-term changes in inflation and the rates and whatnot. But if you're holding good companies and have a longer-term outlook, those management will figure out how to survive in any interest rate environment. Right? Great companies have lived through the mid-teen Fed interest rates, and I also have lived through zero interest rates. But if you're not invested in good companies, but you invest in the companies that always need external help through by borrowing from the market, then it's not that the Fed rate increase is a problem. It's the problem is that we are not invested in the good companies. So anyway, so the companies that depend on these rate cuts, they will bleed. So especially if you look at IWM, which is where we have 40% of the companies don't make any money. These are small and medium business. So IWM has sold off the most over the last, so what its drawdown is almost 11%. Because these are the companies that really get impacted because they have higher debt, they need external money, and if you have to now renew the debt at this rate, it changes all their calculations. So, but does it impact a company like Apple, Microsoft, or the good company with a strong balance sheet? Not much. So anyway, this is again another interesting chart. Our common knowledge is when the Fed start to cut interest rates, right? You will also see that the yields are starting to come down. And so they generally go in correlation, to each other. And this is what we saw. 10-year yield before and after the Fed cut rate. So before the Fed cut rate, a Fed rate cut, that's been almost correlated on the left side of this. And then we got a Fed rate cut last year. Even though the Fed has cut the rates, we are seeing 10-year yield going high. Right? So now this week, the 10-year yield has hit almost 4.7%, and there were talks about maybe it'll go above 5%. Now, if the yields continue to stay high, that is not good for the markets. Why would I have to take a risk of investing in equities when I can make risk-free 5%? As risk-free as you can get in this world. I can make 5% by just buying T-bills. Or no. Why do we need to invest in the stock market? So even though, the Fed had cut down the rates, but the yield continued to increase. And I think now the 10-year is close to 4.7%. That's what we saw why the stock market reacted the way it has. Two reasons. Number one, fewer rate cuts anticipated. Only one. Number two is yields are just persistent. Yields are not going down. And if yields are not going down, and if I'm a big, pension fund manager, and my obligation is I need to just make 7% to pay to the pensioners, and now I can make 5%, almost 5% risk-free. Why I want to go to the equity market with billions of dollars, right? Maybe I'll put most of my money in T-bills and maybe play with little bit of money and try to get to the 7%. The things are very different if your bills or the notes are trading at 2%, 3%. Then that you need to, I'm talking about big institutional money. Right? Then you need to have a big short gap that you need to cover, and you can't get to get that the return. You have to invest in the stock market. Of course, there is a risk, but then, hey, I need to have that return. So if the yield continue to stay high, that's going to be challenging for the market, right, in short term. So we'll see. But this is where the current status is. I'm not seeing any more YTD performance charts. I saw a lot more on Twitter. Everyone talking, showing how well their portfolio has performed. I'm up 30%, 40%, 60%, whatnot. No more right now. Why? Because, we are down we are down now. This is SPY. SPY overall drawdown, we are 5% drawdown right now from its all-time high, recent all-time high of 609. We are almost 4.7% drawdown. It's down 0.7% for the year, which is just started, right? We are not even 2 weeks into the year. Maybe just one full week in the year. It's down for the year. Same as with the QQQ. It's down almost 6% from its all-time high in December. I think December 18th or somewhere, that's where we hit a new all-time high. And year to date, it's down 0.6%. Nobody wants to share their portfolio right now. This is IWM, small and medium business segment of the stock market. It's down almost 11.5% from its it's not, I'm not sure that's an all-time high, but from the recent highs, down 11.5%. And for the year to date, it's down 1.95%. And the fourth big index is Dow Jones Industrial Average, down overall drawdown 7.14%. Year to date is down almost 1%. So not the best start of the year that you would wish for, but hey, come on. We had a great 2023, we had a great 2024. So I'm not complaining, right? That's okay. That's what the market does. It goes up, it comes down in a short term. But if you extend your time horizon, well, we're pretty good. We're still looking pretty good from investing in the market. And as long as we don't do stupid mistakes of that of our own, and then we're still looking good. Now, whether are we gonna get another third year of 20% plus return? That's going to be the second time in the last 75 years that it will ever happen. Right? The only time that it has happened is, I think last week I shared the chart. It was in 1990, like 1995, 96, 97. I think 3 or 4 year continuously we got some good returns. And that's the only time it had happened. Maybe if we get another 20% return because of the change in administration, all the tailwinds that we have discussed in our previous sessions, that's going to be the second time. I'm not holding my breath on that. It'll be okay if the market, doesn't give 20%, and wherever we are here for a long game, not for just 1 year, 2 year, or 3 year. My basic stuff is if you want money next 3 years, it should not be in the stock market anyway. So why do I care where the market goes in next 3 years? So quick look at the fear or greed index. And it's fun to see how quickly, this thing switches from a greed to fear based on what has happened in last 2 weeks. We are pretty close to the extreme fear zone. We are in the fear category. That means this is the time to go shopping. When nobody wants to buy stuff in the market, you can get the stuff cheap in the market at a reasonable price. I'm not sure I'll call it cheap because market is still not cheap, but it is cheaper than where it was 3 weeks ago. And stock market is the only market where people don't like discount. We don't like discount. We want to buy the stuff when the stuff is at high. Right? When everyone is clamoring for XYZ company. Maybe this is the last time I can use an example of my favorite stock XYZ. Because damn, Square or the Block, they're changing their ticker to XYZ. So I just tweeted, I said, why are you doing this? Because, it's very easy to say, let's talk about a stock XYZ because it's a fictitious stock. Now XYZ won't be fictitious anymore. I don't know when they're going to change the ticker, but Block is going to change the ticker to XYZ. So anyway, I have to figure out a new alphabet soup. But the point still is, when any stock is going to all-time high, when everyone is talking about the stock, when it's in the news, in the media, in the podcast, in these meetups, that's where everyone wants to go and buy the stock. Why? We're never going to get a good deal when everyone is clamoring for that, man. But when nobody wants to look at the stocks, everyone thinks the market is not going to recover. I hate it. I lose it. That's where when we should go out and open our purse strings and say, let me buy some stuff now. So yeah, I mean, I did some shopping on this week. Mostly I closed some of my hedging, etc. So that I did. New economists.
Batman, they have come up with something new. So this is like Batman is what? Broadcom, Apple, T as in Tesla, Meta, Microsoft, Amazon, and what is it? Alphabet, and N is Netflix. Oh, not Netflix.
So they got the Netflix due. Okay, it's because Mac 7 we dropped the Netflix when we came with the Mac 7. When we did FAN, we did not have Microsoft, we got what FAN, MAG, and all that. Okay, so new acronym is Batman. Hello, yeah, cool. Yeah, markets have tendency to give names. It makes discussion more interesting. All right, so that's around this. Now I would like to get into this in the backlog from our previous session, unless there are any other questions. Hey guys, if you really are looking for, and again, no one can predict where the market will go, but I have some, my own, I would say, a loosely written rule saying that if the market is down 5% from its recent highs, I'll maybe invest some, right? Add to my portfolio. If it's down 10%, I'll add a little bit more to my portfolio. Can it continue to go down? Sure. I don't know. Nobody else knows. Anyone is saying that they know where the market is what's the market gonna do in next month or this year, are just BSing, right? They're just taking a guess. And like say, some of them will turn out to be true, and then we will put those analysts on pedestal. We will start idolizing them for until the year comes along when they are wrong, and then we just ignore them. We hate them. We did this stuff with Cathy Wood. 2021, she was the darling of the markets, and now 2022, 2023, everyone was just out for the blood for Cathy Wood. We did that for Mike Wilson. 2022, he was the god of the street. In 2024, he lost his job. Morgan Stanley pushed him aside. We idolized Tom Lee in 2023, right? And 2024 didn't really work out that great, especially his call on the IWM or the small and medium business segments. He told it'll be up 50%. Nowhere near that. And now we are all, we are all idolizing Dan Ives and other AI analysts. Sure, as long as the AI company goes up, it's fine. And I'm 100% sure when some of these AI, the wind from this AI theme will get sucked out, we'll start hating Dan Ives or other analysts. So we see this every time. So I'm not surprised. Cool. Let's talk about a couple of questions that we had from a previous session. Let's address that. First one, that was around, and I want to start a new year with that. Some of the very basics things around investing in. How do I identify a good business, right? And my idea is if you're investing, if you're in a stock market, try to invest in a good business that will work out for you over longer term. So the idea is, how do I identify? What do I mean by a good business, right? It's not a stock price. I don't care where the stock price is right now when I'm trying to look for a good business, right? I want to look at the characteristics of a business. And few things that I look at is moat. And we'll get into the details of these. Moat means what's the advantage that this business has against other, right? It's not it's a dog-eat-dog world. If you're in a very profitable business, but you don't have any moat to protect your business, competition will come in. Right? So it might be a great business for a year, for 2 years, until the competition catches up with you. So good business will have a moat that they can protect their business for longer, for years to come, for decades to come. Now, there are different type of moats. There are 7 type of moats. I'm not going to get into the details of those. If we search for a moat, they'll tell you what different type of moats are. But 2, good businesses have management that has got some skin in the game. Hey, we both are riding on. I would like to invest in a business in which the management is with me. The CEO is sitting on the same boat as I am. The leadership is on the same boat. Then I know if there is a leak that appears in the boat, the leadership will fix it. But if they left me in a boat separately and they're in a different one, come on, then we are not sailing together. then our interests are not aligned. So as a shareholder, I would like to be with the management which has got skin in the game of, in the business. Profitability. Great, you got good moat, you can protect your business, but if it's very difficult to make money in the business, as a shareholder, I get what's left out after you paid all the expenses, right? So the business should be profitable. And of course, there are levels of profitability. You're not going to get any profitable business if you're just starting off, or at least I need to know that there will be a path to profitability. Right? Capital intensity. I love the businesses which are low capital intensive. But recently in AI, I'm also okay for the businesses which are high capital intensive if that high capital intensivity, I don't know what the word is, but high capital requirement becomes a moat, right? Because hey, you can't have that many competence, not especially looking at these businesses around AI. To train an AI model, you need to have at least $100 million, right? That's a very big moat that the companies have created around themselves. You need to buy those hundreds and thousands of NVIDIA chips, the Blackwell chips. Not everyone can afford it. It's a hugely capital intensive effort. But that has created a moat around it that not any company can come and disrupt you. Secular tailwinds. I want the companies that are expanding in the markets that continue to grow. Right? What good it is if the market is not growing? Because you can, as a business, I operate in a market environment and I can't be bigger than the market is. Right? So if I'm in a market, and of course my competitors are, if the market continues to grow, if the size of the pizza continues to grow, and I still have the same percent of the market share, I'm still continue to grow. So we want to look into the companies that are operating in an expanding market. And then finally, yeah, you should be able to generate some cash flow, because at the end of the day, when you're looking at very far ahead in future, the valuation of a company is a sum total of all the cash that it generates discounted to the present value. Okay. That's a very basic the gist of the discounted cash flow model that's being used by bankers and analysts and all the CFAs. At the end of the day, is the sum total of all the cash flow generated by the company in its lifetime discounted to the present value. So it should be generating cash flow. So let's talk about moat. Looking at moat, how do I know that this company has moat? Of course, if you understand the industry, you'll be able to figure it out. If you are from a particular industry. But if you're not from that industry, and then how do you know that this company has demonstrated that it has got a moat or not? So there are a few things that I look at, and this is what I want to share. I look at the gross margins of the company. Does this company has a good gross margins? Now this depends from sector to sector, business to business. If I'm looking for a tech company, software company, I would want to look at a gross margin which is greater than 60%. 70%, right? If you're a SaaS company, if you call yourself as your software company, SaaS company, cloud-based company, and then you show me that your gross margin is like 30%, I'm like, what the heck? Then you're not really a SaaS software company. You have a lot of stuff which is other expenses. I won't give you the valuation that I will give to the other software company. So you should have a good gross margins, and it means you are able to raise your prices without sacrificing your business. The other thing I want to look at is return on invested capital. Right? So these two I look at it, and this should be consistent over a year, right? I don't want to look at maybe last 1 year or 2 year, you had a good gross margin, higher ROIC, but I want to look at, have you been able to maintain it, sustain it over last 5, 10, 15 years? If the company has been around for 20 years, yeah, what's your average or CAGR, average gross margin over last 15 years? Or at least minimum 5 years. Right? Skin in the games, which is, hey, if you are a founder-led company, And there is another study that we looked at. The founder-led companies have consistently returned, had a better performance in terms of shareholder returns than the professional management, because they can take a decisions which if you are a founder leader, you can take a decision which maybe a professional manager may not be willing to take. We've seen many of the companies in the recent times have pivoted, and it cuts both ways. So it really depend on what kind of a founder you have. If a founder that's not shareholder friendly, then we are in trouble. But if a founder that is shareholder friendly, and that's the what company that we want to invest in. Right? Third is high profitability. So I want to look at the companies that are converting their revenue into earnings, operating earnings, right? Not net profit margin, but at least operating earnings. And then invest in the companies that convert their earnings into free cash flow. Because the net earnings is also an accounting term, and in a lot of games you can play. If you are I think Warren Buffett had said this, that the accountants are the most lethal people on. Sorry, if you are any of you is an accountant, it's not directed towards you, but generally, you know what I'm saying, right? There's another one. I was reading a book, and in that they were hiring for an audit firm. So they were interviewing a lot of folks from an audit firm to see who to give the contract to. And then of course, I think this is just a parable. That's probably not a reality, but it happens. And they call a lot of folks from these accounting firms talking about, hey, look at these all my finance, the company's operations and all that. Look at all the numbers and tell me what would be my net profit margins, right? So those accountants looked at it and say, you know what, it'll be X%, Y%, Z%. The fourth one said, who got the job, was, what do you want it to be, Mr. CEO? So accounting is different, but you can't, it's very, very, very difficult to fake the cash flow statement. So if you're investing, it's important to look at a cash flow statement. But, if I'm looking into companies, I want to have them a high operating margin. I want to focus on high operating margin, net profit margin. And again, these numbers are not sacrosanct, greater than 25%, greater than 10%, not sacrosanct, but I'll be willing to, tweak these numbers based on the industry the company is in. But you need to start somewhere. You need to narrow down, 3,700 companies that trade on the stock market to a handful of companies that you can then deeper to analyze it, right? So you start with whatever, depending on what industry you live in, what's the industry average would be, and then you tweak your filters, or if you want to use it for your screeners, you can tweak these numbers based on the industry that you're looking into. Okay. Third is capital intensity. How do I know if the business is capital intensive or not? Capital intensive means if the company has to continuously grow, they need to continuously add more cash, or basically have to spend more capital expenditure, buy more machinery, more land, invest in or buying companies, etc. So you look at your capex, capital expenditure, part of a revenue. If you made $100 million this year, but if you have to sustain making $100 million, if you have to invest $50 million next year, that's a hugely capital intensive business, right? So it will continue to need a lot of capital to be fed in, right? I like the businesses which are low capital intensive, because then it means I don't have to put in as much amount of money to make the same amount of a revenue, right? Or you can look at capex divided by operating cash flow. Some numbers you can look at. You can look at your capex to figure out how capital intensive the business is. Fourth one is a capital allocation. This is the one which is least talked about and the most underrated quality of a great CEO. There's a great book on this one called The Outliers. If you're really interested in the topic, you should read that. And why? Because most of the CEOs, either they come from a sales background or will come from a finance background, Or if you're in a tech company, they'll come from a technology background, right? Not many CEOs are focused on how to generate the value for shareholders. Right? And capital allocation provides it's a very important aspect of increasing the value for shareholders. So what do I mean by capital allocation? Here, once you're done with all your expenses, etc., what's left out after of your revenue? What do you do with that? Are you going to reinvest in the business? Are you going to pay dividend? Are you going to pay down debt? Are you going to do a M&A? Or are you going to distribute the remaining cash to shareholders in terms of dividends or share buybacks? These are very important decisions, but these are not taught. You don't learn it in a sales side of the business, nor you learn it on the engineering side of the business or a product side of business. But there are many companies. If you have a great capital allocators on the top leadership, those companies are done great for the shareholders. So I would want them to invest in a business if the company has good return on invested capital, right? Like Berkshire Hathaway, they have never paid a dividend, I think, except once in their lifetime of some 50 cents for something, but they never pay dividend. But Warren Buffett doesn't want to pay dividend because he can reinvest the cash into its businesses and generate much higher return for its shareholder through its business rather than handing over the money to the shareholder. So if your company can have a good return on invested capital, I don't want those companies to pay dividend to me. Right? Or if the company has got a higher debt, guys, pay down your debt.
Besides, the dividend is taxed twice anyway. So you're just kind of losing that also, right? Versus letting it work and compound over a period of time.
Yeah, if you're paying the dividend. Yes. So if you're paying the dividend, basically company pays the tax on dividend, the dividend, those who receive the dividend, they pay the tax on dividend. That's why I'm not big on dividends unless you need to have a consistent income stream. And I know a lot of people are huge on dividends. They want to look and hunt for the dividend paying companies. But if I'm a shareholder of a company, I don't want my company to pay dividend to me unless they have gone through at least these two ones. I'm not big on M&A. I would rather have them buy back the shares instead of paying dividend to me, because dividends are very tax inefficient. So anyway, if you have a higher debt, pay down the debt. It's like, should I invest or should I pay down my credit card loan? Guy, if I pay down my credit card loan, that's immediate 20% return on capital. Maybe I'll pay down my credit card loan. And again, there are certain industries in which it is good to have higher leverage, because you can write off those taxes, the interest can be expense, and that reduces your net profit. You pay less taxes. But there are very few good CEOs who leverage the debt in the right sense, right? And companies like utilities companies, telecom companies, I'm okay to have a higher debt because you have a consistent income stream coming in. That, I'm not gonna shut down my power tomorrow. So they have a huge visibility into what their income is. And then they know how much they have to pay in interest. And that's why many of these companies are leveraged, because they have a consistent stream of income. And then there are companies like, I think John Malone is very famous for leveraging debt in 1980s, 1990s across a lot of these cable companies, telecom companies. But there are industries in which you can leverage debt. I'm talking about, generally, if your company is highly leveraged, the only thing that gets into the bankruptcy is if you can't pay down your debtor or your creditors, right? So if you have a huge creditors, and your business can't make consistent income, you end up in a bankruptcy code. Use for M&A, merger and acquisitions. 2/3 of merger and acquisition result in a destruction of shareholder value. So should be done cautiously, right? Because this is where there is, I say, inherent conflict between the shareholder versus the CEO. Because CEO would want to do merger and acquisition. Hey, come on, that fuels my ego. Now, till now, I was managing a 10,000 person company. Now I acquired another company. Now I'm managing 15,000 person company. Or, you can change the person to a market cap or to geography, whatever. I have expanded my empire. As a CEO, as a leadership, it's good for me. Looks great on my resume. And talk about that now I'm a CEO of a $50 billion company instead of $20 billion company. People look up to me. But is it really great for our shareholders? Not really. If you go back and look at M&A, like 2/3 of M&As fails. They don't generate any value for shareholders. So I'm a little cautious. And I have some dogs in my portfolio who just, did a huge M&A and all didn't work out. That's not to say that all mergers and acquisitions are bad. I mean, one of the greatest acquisition, Instagram, one of the greatest acquisitions done by Alphabet and Meta, respectively. But you should be cautious around it. And because there is a leadership get blinded by expanding their empire versus creating value for shareholders, you got to be a little cautious. So if you see the companies that you are holding continuously go and buy another companies, you need to think through it. Why? Is it really adding value? Or are they just doing it because they need to continuously show revenue growth? Right. Finally, is distribute the money. If you can't find a good use of money, then instead of having it swell in your balance sheet, maybe distribute it. Yeah, but that's the last one is distributing. I would rather have them do buybacks than pay dividends. But these are the 4 things in which companies can return or allocate the capital that they have available. All right, for the next one, growing market. I want to, and what's the evidence that the market is growing? If they are continuously able to, grow the revenue, it means they're growing their market share. Either they are taking away from the share from the competition, which is great. If not, at least the overall market is growing. So I want to look at the revenue growth for past 5 years, 10 years, and then, is the earnings also growing or not? So these are the things that I look for. Now for the cash flow, again, I want to see if the real free cash flow is greater than 0. There are many companies that have been able to show cash flow. Again, I was talking about the accountants earlier. When in 2022, when the whole, the theme in the markets has changed from a revenue growth to being profitable, and the market started looking for companies that generate cash flow. Many companies that have not generated cash flow suddenly started to show cash flow and actually start talking about cash flow. But were those real cash flow? What do you mean by real cash flow? Any guesses? What games company play? I mean, on to show cash flow, free cash flow. Come on, any guesses? So one of the very common stuff that I've seen in the especially on the tech side is exactly they pay employees in stock-based compensation. So when I'm looking at a company, I just go and see stock-based the reported free cash flow, subtract the stock-based compensation, and then I'll say, is it a real free cash flow or is it, hey, I'll pay my employees in the stock options and not pay them a cash? So, and I saw in 2023, many companies that, they started to show free cash flow because they jacked up how much they were paying their employees in stock options, which shows up in another way in terms of share dilution. Right? So instead of a buyback, it's basically diluting us. Again, this is not a, you can't take this rule and say, I'm never going to invest in a company that has never shown a real free cash flow. Right? You have to use this yardstick judiciously. But these are the things that I would want to look at. These 5-6 things will give me a bird eye view of is it a company that I want to now further dig down and now start reading their 10Qs, 10Ks, earning scripts or not? If the company fails on almost all of these metrics, then I'm like, I'm not even interested. Don't talk about that. Right? I'm not interested in the company. If a company looks good on 3 metrics and not on other 4, yeah, maybe I'll see, what's happening in the business. Sure, they can't generate a free cash flow right now. Well, that's okay if I can figure out that the revenue has been continuously growing and the margins are good. So these are the few stuff that I, use for looking at if the business is a good business or not. Then comes about, let's talk about the stock price. At what valuation is it trading? What am I willing to pay for this business? But if it shows up red across all these, I don't want to go in there. Right? Or maybe I'll only put in my gamble money in this, right? 5%, 10% of a portfolio. That's my moonshot portfolio. Yeah, I'll put only that. But if it shows up green on all this, yeah, then I'm interested in the business. Cool. All right. So that's around at least criteria that I look at, or the characteristics that I look at in any business to know if it's going to be a great business to own in portfolio or not. Let me look at some questions now.
Hey, Vivek, we call the gamble money, we call Bora Bora money. You make a killing, you go to Vegas, you go to Bora Bora, French Tahiti,
Great. Brian says, I'm long in Batman growth stocks and big crypto like Bitcoin ETFs. What's the best way to hedge my portfolio? Options, take profits and keep cash. To buy if market drops. I don't know about options, but an option that you learned how to hedge your portfolio with an options in mid 2010s. Yeah, so I've been the reason I got into options was it allows me to hedge it. Yeah, so I've been doing hedging on options. 2022 was a great year for the option side of the house because all the hedging worked out very good, and yeah, so I'm not a big fan of selling the stock, because if you sell the stock, take profits, then at least you're paying whatever your tax bracket is to IRS. The question is, do you expect the market to drop that much? Let's say if your tax bracket comes out to be 20%, 25%, then anyway, you take a hit of 25% by paying that to IRS immediately. So I would rather see, first of all, do I need this company that I hold my portfolio for? Do I need this money for next 1 to 2 year or 3 year? If not, yeah, market goes down for a year, that's fine, who cares? But if you can't withstand that volatility, then yes, you could hedge your portfolio using options, do a lot of delta reduction trades, but there's a cost of doing it, which is on opportunity side, right? Like 2024, if I look at it, if I had not hedged my portfolio, I would have added another 5% upside to my portfolio. But I'm okay with it. I've done, pretty well this year. But I had to forego that additional 5%, which I could have made if I had not hedged my portfolio. So nothing's come free. But I want to reduce the volatility in my portfolio, so I'm okay with losing that 5% additional upside, because that hedging helped me in 2022, 2018 to not get scared and get out of the market. Or I would say in 2020, March 2020, when the market fell down 35%. I always have some hedges always on. So that's a decision you need to make in terms of how much you want to hedge. If you're 100% hedged, if you're completely hedged, then if market goes up, you're not going to make any money. So you decide how much you want to hedge. And I think I do have some videos of various ways to hedge your portfolio. How do you identify, which instrument you want to use for hedging, how much of a hedging you want to do. I think that's a video number 12 or 13, where we talked about portfolio hedging using options. I hope that helps. But yes, I do use options to hedge portfolio or to reduce the cost basis, right? The other very low, I would say underrated aspect on which I see on investing, I don't see a lot of people talking about is cost basis, reduction in cost basis. If I own something free of cost, it makes it much easier for me to hold it through any of the, downturns that we see. So again, my focus is always to continuously reduce the cost basis of the stocks that I own, and options help us in doing that. Right. Jason, you had a question on jobs report.
Yeah, I mean, this is the question I've been grappling. My wife has lost a job in December, and a couple of friends have been lost. And so my question was, is the jobs, can we see the quality of the jobs? Because, December might be a good high because they might have a lot of seasonal jobs, McDonald's jobs or Macy's kind of job versus, high-tech jobs, which are very high kind of paying ones. So my question to you is, I mean, is there a quality of the jobs report we can refer to, or is it just because the numbers seem to be pretty high, which may be revised in the next job report,
Yeah. So that's, I don't pay too much attention to the job reports or change your portfolio because it's seen every quarterly, or the job numbers get revised, and I hate that you guys are like hundreds of PhDs and you can't figure out what the real number is, which I don't know why this government works this way, because you're in any case, the numbers could get revised. Number two is these job reports just tell you the number of jobs, and I'm sure most of these jobs, first of all, you can get the details if you go to the Department of Labor and look at the detailed labor report. You can get these numbers. I have not looked at that because I don't really pay too much attention to what the number is showing up, because these numbers will get revised anyway. And this administration is going out anyway, so they may want to go out at a high note. Later on, if the number gets revised towards lower number, it's somebody else's problem.
Government's number. Okay, got it.
It's somebody else's problem. And we have seen the numbers getting revised like 20%, 30% off. How much error can you have, guys?
Yeah.
So, but market soon, right? There are algos which will just wake up and start trading based on whatever the number comes out to be. But
Just,
anyway,
yeah,
my
just take
gut feel is this: the
Yeah.
jobs in the tech sectors are not there. I mean, what was it, Meta or Salesforce? I think it's Salesforce.
Salesforce announced that they're laying off people and AI agents they'll be hiring. That's what they were talking about.
So Salesforce are told they're not going to hire any more software engineer. They're going to hire the 2,000 salespeople. Which is, what an irony. They want to hire 2,000 salespeople to sell the AI agents for their customers, which will do sales for them. But anyways, they're not hiring any more software engineer. I know of my friends, my ex-colleagues, and they are still, trying hard to look for a job, are still out of a job. So on the tech side, yeah, no jobs, because the AI has have reduced the amount of software engineers you might need. Right? If you are a startup, you can't get a funding if you're telling I need 50 software engineer. Well, the VC will say FO. Use your Codium or Copilot. Use whatever these. You get two high pay senior engineers, and along with the Copilot, you can do a job of 10 software engineers, right? And I'm not exaggerating.
Mhm.
There are my friends whose kids have recently graduated on computer science or on data science, can't find a job right now.
Right now, I totally have one myself actually. Somebody called me up the other day. They're looking for their kid.
Yeah,
It's-
they can't find job now.
I-
And because hey, I can use these code generator tools. If I'm a senior engineer, I don't need a junior developer with me, because hey, code does it for me. Then I'll review it and see whether to put that into my repository of code or not, whether to accept or not. Why do we need a fresher out of a college? That code can be generated by AI itself. So I think it's the numbers are high because of the seasonal one, like you said, all the seasonal hiring during the holiday season, and maybe on the services side. But the breakup will be available. The third thing is, many times we get surprised because it's a lot of a government hiring happening, right? So you can get a breakup of looking at what's the job numbers are. The data will be available.
Got it. I mean, then not to reach too much in it. That's what you told already.
Yeah.
There's the criteria. So
Yeah,
basically,
when the market, did what it did, I'm like, okay, whatever. The numbers get revised. Anyway. Ramesh said dividend get taxed twice. Yeah, that's what I don't like in companies paying dividend. It should be the last option. But there are investors. Why do the company pay dividends? The question could be, why do the company pay dividends if dividends are not efficient? Because you have investors who need regular stream of income. And which are those investors? If you're a pension fund, you need to send pension out to your pensioners. Right? Really, so you need to have a consistent income coming in. Whether tax efficient or not, you need to have that cash flow. So only if you have the need for that cash flow, yeah, invest in a high dividend paying. The other thing could be investing in a dividend. The other logic could be generally the dividend paying companies are, the only way they can pay dividend because they have extra cash available. It means they have a good business. It means they can convert their revenue into profits. It means that at the end of it, that means, it's that business is a good quality business. That may be another way to look at. If it is a dividend paying company, probably it's a stable business, right? And the market goes crazy. It will first go crazy on the companies that are not profitable, companies that don't have a path to profitability, companies that have been maybe called zombie companies that have been surviving on low interest rates, etc. The dividend paying companies will fall less. So if you hold a dividend paying ETFs or the company or the stocks in 2022, the unprofitable so-called Cathy Wood companies fell the most, and the dividend-paying companies fell as a less. So that could be another thesis of investing, but that's not that I want to have a high dividend. It's because the business quality is better and they fall less if the markets turns around.
so basically, what you're saying is that Vivek is saying is we're looking at good, great businesses with that kind of evaluation and pay very competitive price. So what price you pay for them also matters in the long run, right? That's what you do.
Yes. So Howard Marks has said, right, it's not that you buy good businesses, it's you buy business well. So then you look at what's the valuation I'm willing to pay. Right? I own Palantir. We talked about Palantir when Palantir was $6. I'm like, that's pretty cheap looking at the business. And I've been following that business since it came DPO, right? And I bought it when it was $26 as a so that it stays on my radar. And good thing is that I bought at that time. So because it was in my portfolio, and when I saw it as $6, I'm like, it wasn't that bad a company. I looked at again and say, hey, it's available at much cheaper price. But when it becomes 45, 60, 67, I'm like, dude, I can't justify this valuation. I'm okay to hold expensive companies in my portfolio. But one lesson that I learned in 2021 was sometimes the companies become egregiously expensive and it's okay to trim. I'm not out of Palantir, but I trimmed my position. Right? So first, then I look at, hey, so Palantir probably satisfies skin in the game, not profitability, capital intensity. It's not even there yet because it doesn't generate. Growing market. It did not have a real free cash flow. I mean, one of the biggest issue on the Palantir was, and the Snap was, they are paying a lot more in stock-based compensation. But over the last 2 years, they have reduced that, right? So, but it does not. So today, I'm not as bullish on Palantir because it doesn't pass the smell test of operating margins. They have a mid-teens operating margins, and then they call themselves as a software SaaS company. I'm like, the numbers doesn't match. It doesn't show up in your result.
So what point you'll be comfortable with Palantir? I know it is being a nice momentum you had last year.
We'll talk about Palantir in terms of what I'm comfortable buying it. And I'm 100% sure that I will not be able to sell it at the top and I will not be able to buy it at the price at which I want to buy. So I'm okay. I sold some of my position at 67, 60, stock went to 80, that's fine. And I'm willing to buy it at, when we go on look at an anatomy of a trade, I'll share that.
So
And
you're
the
basically playing
reason.
house money right now.
Oh yeah. So I have recovered everything what I put in Palantir. Yes. And but I'm still bullish about the business of the company. I'm not that bullish about the stock price. I mean, now it has fallen down from 80 to whatever 66, etc. But still, I think it's expensively priced. But that doesn't mean to say that, it's a very popular stock among retail investors. So don't go and short the stock. You know, you don't know when the Reddit crowd might come after you. So, so it's okay. I hold some stock in my portfolio. I mean, I still hold that in portfolio.
You're following Roaring Kitty stocks as well, like
Ah.
GameStop or something?
Is it still active? I'm not sure.
I don't know.
No. All right, Rajiv asked a question. Have you come across any screen or ETF that come close to your good business criteria? Let me just pull that. I, in fact, did the screener yesterday. I mean, I've didn't. So, for example, in this one, I said market cap over $10 billion, EPS growth over 10%, right? For the next 5 years. This is where you talk about profitability, growing profit, not leveraged company, right? Return on equity, basically ROIC this year over 10%, for next 5 years over 10%, revenue growth, free cash flow yield should be positive, operating margin of 20%, current ratio or means they can pay down their interest and all that. It shows up 19 stocks. Now, am I going to invest in all 19? No, probably I look at these individual ones and say, do I understand this business? Do I know, do I already have a similar business in my portfolio or not? So I start to filter this down. Now, if you're saying, oh, come on, it's only 19 is less, maybe you want to relax a little bit, because let's say if you're looking for a company that is small, then maybe over 10 billion is not a criteria you want to put in. Maybe you want to put in over 1 billion. It brings up 25 stocks. So I need something to start with. And then you can, instead of me trying to invest in, looking at 3,000, I can start with some criteria. And this, looking at these combination of criteria has helped me in figuring out, okay, now where do I want to, dig deeper? You can create your own criteria. Visa might be a good stock, for an example. Yeah, so Visa MasterCard has a huge net moat which comes through their network. So
I'm a big fan of Microsoft as well. More it goes down, I plan to buy more. What do you think of Microsoft as a business?
Microsoft shows up green on many of these. My only worry with Microsoft is right now their OpenAI. What kind of a risk that OpenAI brings onto them is a little bit. Other than that, I don't have any concerns on Microsoft. OpenAI is losing tons of money, and not only just losing money, their whole corporate structure and all the profit, non-profit, I don't know, the conversion, IRS will come behind that's an area which is like a black hole for me. I would say in long term, again, this is my thesis, is this LLM models will become a commodity. I won't even know what model is being used in the back end. Right? Today, these are novelty, and a lot of hundreds of millions of dollars is going in there. And I think 5-10 years later, it will become a commodity. I don't care which telecom company or which fiber optic, which infrastructure company is routing my internet traffic. I don't care. But in 2000, all these internet or fiber optic company or the companies that deal in, running these wires were the darlings. It happens all the time. The data center companies were darlings, Exodus Communications, like these are the darlings. But do you care which data center is your server hosted in? That's become a commodity now. So I think few years later, these will all become commodity. But today, that's the hottest thing, LLM models.
Yesterday, Kramer said Verizon sucks. Can you believe that?
I mean, from a return perspective, it does as compared to others. What has Verizon done? Almost nothing. I mean, it's a good dividend paying stock, But overall capital appreciation, if you were invested in, let's pick a Verizon is VZ over last, oh my God, it's now 37. Let's say pick up last 10 years. Okay, but 20 years, 10 years. And maybe let's compare it with SPY.
Because I thought Verizon was the gold standard, and T-Mobile is the return standard.
So how do we have them start together and to compare? Hold on, let's see if I could do anything like that. But in any case, if you had invested in Verizon and versus SPY, it's not a great investment for you. Look at that. 5 years, Verizon is down 36%. Of course, this is just the capital. You can add whatever the dividend on it. It pays, I think, 6 or 7% dividend. And then Spider pays you, close to 2% dividend. But you didn't make money in Verizon. So I'm not a fan of Jim Cramer, but I know where it may be coming from. All right, jobs, construction trades not taken by AI. Yeah, that wherever you need to work with your hands, that's not taken by AI. Completely agree. I think the vocational training should be a hit. Your welding jobs are not, I could say, well, probably in automotive, they're all taken by robots, but your plumbing at your home is not taken by AI. J, common stocks on from Phil Fisher and the Intelligent Investor. So if you're reading Intelligent Investor, focus on chapter 5, 8, and 20. Otherwise, you could get bored and might just throw a book because many of the stuff doesn't make sense in today's world. But chapter 5, 8, and 20 are still applicable. And it's a great knowledge if you're looking for intelligent investor. I've seen some people starting on intelligent investor and say, how come this is one of the greatest book on investing? It doesn't make any sense. Because, it was written in 19 whatever 40s or 30s from Benjamin Graham, and he had just suffered from in the depression. So his way of investing is very different. And which Charlie Munger changed Warren Buffett, saying Benjamin Graham's way of investing doesn't work, Warren. But chapter 5, 8, and 20 are gem. So read those at least. All right. Other question from our last week was Aditya is here. So he has fund managers that have consistently beaten the market for past 10 years. So Aditya, I thought a lot about it, and it was also I'm reading through an audio book written by the real wolf of Wall Street, Jordan Belfort, and my daughter like, what are you listening to this guy? I'm like, he was a fraudster. He's been in the trenches of Wall Street, and you know how Wall Street fleeces people. So now he's like a speaker and all that stuff, right? So, and anyway, so we're talking, and he was referring to a lot of studies which we have known, and we're talking about the origins of Vanguard and all that stuff. I'm like, it's an exercise in futility trying to find out managers that are consistently beaten over a long period of time.
Which book, Vivek? Is that The Way of the Wolf?
I have a. Well, let me just. The Wolf of Investing, Jordan Belfort. I mean, it's I have an audiobook on my phone. It's called The Wolf of Investing. Okay, so I thought maybe let me go to Spiva, and again, I think this is still true. The great fund managers, if you look at, let's say, Nick Sleep, etc., they've all either not accepting money from additional investors, outside investors, or they are, managing their own money. Or when the fund becomes too big, it is difficult to continuously beat the market. That's what Warren Buffett also said. Give me $50 million, I can easily, or start with $100 million, you can do 50% per year. As the fund becomes big, you can't. So today morning, I went to the SPIVA report. I thought we'll have the maybe end of a year 2024, but we did not. We have a mid-year report available. And this basically, rather than bore you through the whole, so let's focus on this graph. This tells us the underperformance of active fund managers with respect to, the overall market. So all large cap funds, if we're looking at first half of 2024, close to 60% fund managers underperformed the large cap passive fund or ETF, right? Come to 1 year, as you increase your time horizon, the underperformance of the fund managers continue to increase. Like more than 80%. Over a 20-year period, more than 80% of the fund managers don't beat the damn passive index, S&P 500. So I'm like, why would you want to go and try to figure out of pools of fund managers, those 20% that may have been able to beat the market? Just doesn't make sense. So I would still say, stay in the ETF world, stay in the passive ETF, pick up SPY, because most of the fund, 80% of the fund managers anyway, you will be better than 80% of the Wall Street fund managers. Let me put it that way. So don't be too greedy to come out to the top 20. Come on, 80%, you beat 80% of the smartest people on the Wall Street. What else you need, Aditya? So rather than trying to fight out and move from one fund manager to another one, most of them have, except I think the fixed income instrument, where you actually need an active fund manager can outperform the market if you're looking at a fixed income instrument. Reason? There is no upside. It's a fixed income instrument. So all that matters is only the downside, because the upside is fixed and all that. If I'm investing in a corporate bond of 8%, that's my maximum limit. Now, there is only a downside protection. Will this company go bankrupt or not? Right? That's where the active fund manager for a fixed income can make the qualitative decision, because your upside is already fixed. You can't make more than whatever the coupon rate is. And that's what I've seen in terms of the fixed income instruments. It probably pays to go through an active fund manager. Other than that, if you're on an equity side, it doesn't make sense. There's another one. This is an author from a fund manager from Australia, and he was comparing in terms of percentage of fund managers underperforming in the US one. This goes till 2060. So you see, in the bull market, most of the time, most fund managers, higher percent of fund managers will underperform the market in bull markets. I don't, very few times wherein probably more fund managers did better than the passive index. So this is another one. Shows the active Australian and US equity funds that have underperformed their own relative benchmark. Not in talking about SPY, but their own benchmark. As a fund manager, you pick up the benchmark. Okay, please rate me against this. And then 93% of them, they fail the test over 15 years. 1 year, only 60%. It's like you're telling me, okay, grade me with this, and then you fail it. And still, we are willing to pay billions of dollars to them as a fee. You just I can't wrap my head around this. So US large cap funds, 92% of them underperformed their own benchmark selected by them. This reminds me of the famous Warren Buffett bet, right? He bet it was $1 million bet. for any fund manager to, bet was open for any fund manager to say, you know, next 10 years, net of fee, just beat the S&P 500. Only one fund manager came forward to take that bet. And that's not even a fund. He was a fund of funds. Basically, his expertise was to pick up the right funds. So he was a funds of funds manager. And from, I think, 2008, the bet was for 10 years. He gave up in 2016 because it was so far behind S&P 500. There is no way they could have recovered in next 2 years. No one willing to take that bet because Wall Street knew that, guys, they can't beat the passive index funds, but you know, no one is willing to admit it. So that's how that they run their. How will they get the fee otherwise? Would retail investors do better than the active fund manager? Yeah, I'm we as a retail investor, we have so much advantage to us, which active fund managers don't. Jay is asking source link for fund manager report. Just search for SPIVA, SPIVA. They'll basically put out a report at end of every half year, then end of every year. So which tells you the performance of active versus passive. The 2024 end of 2024 report is not out yet though. Sorry, coming back to the retail investors, let me tell you the advantages that we have, and which is again very underrated topic, right? People always talk about how the Wall Streeters got all the technology, all the analysts, all the brain power. What as a retail investor I can do. Right? Retail investors, I have advantage of investing in whichever instrument I want to, I can. I want to invest in gold. Yeah, sure, I can pick up the gold. I'm not bound by, let's say if you're an equity fund manager, you can't invest in a fixed income. To get an exposure to Bitcoin, you're investing in MicroStrategy, which is trading at 3 times the value of the Bitcoin it holds because you are an equity fund manager. You're not a crypto fund manager. You're not allowed to invest in Bitcoin directly. But I can. If I want an exposure to crypto, I'm not going to invest in MicroStrategy at 3x the net asset value. But if you're an equity fund manager, you're tied there. You can't go outside your area. If you're a fixed income guy, you can't. You are investing in convertible notes. That's why. Right? You can't go. So you have that restriction. You have restrictions around what a percentage a particular company can become of your portfolio. That means you have to sell when your thesis has worked out and your company has become much bigger. Instead of watering the flower, you have to cut it. Because otherwise SEC will come and say, are you crazy? You have a one stock that is now 50% of your portfolio. That's too risky. I can take that risk as an individual investor if you want to. I mean, that's why the nomad investor, Nick Sleep, they had the money in 3 funds, only 3 things: Amazon, Costco, and third one was, I think, Walmart. Then they had to close down their funds because of the regulatory concern. But for the 13 years that they ran, amazing returns. They say we can't find a better opportunity out there. Anyway, so we have a lot of advantage. We don't have an issue of trying to match month or quarter by quarter performance. I can take a long-term view. I can buy the shares when the fund manager are selling it because the stock has gone down, and now they are selling it because they have to show performance by the end of this quarter because they, peer pressure. I don't have any peer pressure. You don't have any peer pressure. You're not competing against anyone. You can take a much longer term view than the fund managers can take. And there are a few more. I think once I put it on LinkedIn or wherever, there are a host of advantages that we as a retail investors have. We're just not aware of it, or we're not taking advantage of it. But we have tons of advantages, and we can do better. If you just buy S&P 500, you will do better than 90% of fund managers anyway. Right? So, but the unfortunate problem is retail investors try to trade in too much in and out. We don't have that patience. And hence retail investors can't do better. It's not because of lack of instruments or the lack of knowledge. It's a lack of emotional wherewithal which kills the retail investors. And hence we say, I can't go through this roller coaster. You take the money. Yeah, in that case, it makes sense. If you can't go through the volatility, yeah, it's fine. You will underperform, or at least you will make some money instead of instead of S&P, which is making, let's say, 10.33% per year. If I give it to fund manager, he'll make only 7% net of fee. Or at least I made 7% because if I were holding it, I will probably chicken out when the market is down 15%. Yeah, in that case, yeah, give it to fund manager. But that's not because they are smarter. It's because we can't go through that emotional wherewithal of, the market going up and down. Or I just can't sit tight on my rear end and ignore the noise. I'll give it to someone. Yeah, that's the reason where, yeah, you can give it to some fund manager. All right, do we have Linda? Linda had another question.
Vivek, as a retail investor, we do not have the luxury for holding forever like Warren Buffett. And that's the reason you were talking about, just be cautious and putting in some things for at least 3 to 5 years so that you make money over a long period of time.
Why do you say we don't have a luxury for holding forever? I mean, I would say we do have a luxury for holding forever. Because I don't have to return capital to anyone.
But again, as retail investor, you said, right, emotional roller coaster. We might kind of, if 20, 25%, 30%, 40% investment go down, so let's say, for example, a lot of people in panic and get out, right?
Yeah, because you need that money right now. That's what I'm saying. The first thing is we need to look at, I don't need to touch this money for next 3 years, 3 to 5 years. And we go and look at the S&P performance. I think last week we had the chart. Maybe I can pull that again. How many times have we had a continuously 5 year of drawdown?
I mean, not only
Never.
that, just like, I mean, I'm just like, I'm helping a friend. SGov fund went a little bit down. They were panicking. So I'm like, it's again individual investor preference also. They do not want to fathom that kind of volatility, though they
Yeah,
have money.
the problem is we get into a game in which you need to be in at least 5 years and then we try to get out after 1 year. So the worst performance was in 1929, which is called the depression, right? Where we had 4 years of negative performance. We never had it. I mean, there are always will be bear markets will always be there. But if I can get through that, I don't need this money for next 3 years. I don't put the money that we need to buy buy food or to spend for your kids' college for the next year. I mean, we are in a wrong at the start itself. We are wrong. So we need to get those basics right. Now these are the S&P return and these over since 1928. Of course, we have bear markets. We had, I think, the worst one, the recent time, 2000, 2001, 2002. The other thing where people, and including us, we have, it's not that, I also learned through the experience, is we to go after the shiny objects. And this, I'm talking about S&P. But there are companies that probably has gone down 80%. I mean, I hold some in my portfolio. I'm glad that the position sizing was okay. That's why I don't invest in individual companies if you don't understand it or you can manage your position size. But bear markets will be there. If you're investing in because I need money next year, then that's a mistake that we as a retail investors are doing to begin with. I don't want to put a worry in the market which I need for next 3 years. Or at least I have other ways to survive for next 3 years if the market doesn't perform. Oh yeah, so we'll look at this, right? Over a 3-year time period, you have a 16% chance that the market has returned negative. 5-year, 15-year time period, you have just eliminated the possibility of negative returns. Increase your time period. And now if you know options on top of it, you can actually protect yourself or reduce the volatility in your portfolio. I mean, the reason I got late on investing news because I don't understand the market. I was scared around it. And once, I started looking at options and all that, yeah, I think I can do that better. Now I know how to fight back if the market goes down. So, sorry, I mean, it's not easy. It's easy to say, yeah, when the market, hey, if the stock crashes 20%, I'll buy it. But when the stock actually crashes 20%, very few people actually buy it. Because that time you start thinking, oh my God, it might crash another 5%, 10%. Right? It's easy to say that, hey, just live through it. But when the actual bear market happens, it's completely different story. But we have to build that emotional stability, which is very, very important. We spend so much time in trying to build screeners, trying to find out the great companies, and then we sell it off if the company has fallen down 20% for no reason. And then that company becomes, multi-bagger, but we already sold off. So that's a tragedy. And if we can't go through this ups and downs, yeah, hand it to someone else who could. And I know it's I probably make it sound easy. It's not easy. It takes years to work on this. So there's a trade I shared on Twitter also on Palantir. Right. Had I win, tail I don't lose. Right? And you must be wondering, come on, these things happen only in fairyland, right? There is always a catch, of course. So let's talk about what I did and why I did that. Right now, as you guys know, I had sold off, so this what I did because there's an insane amount of premium. Palantir or some of the other, I'll talk about, I think when I talk about a crypto side, we look at a Bitcoin ETF, there's an insane amount of a premium available on options because the IV is high and there is a good amount of premium you can get it if you're selling options against it. So this is what I did. I sold a short put and a call spread. Right, this off on Palantir. Let's go to the PLTR. Okay, and wait. So let's look at 1 year. Let me get rid of this, hide this comparison. They added this new hide feature. I like that. So if you look at really Palantir going to 21st Feb, right? What I did was, first of all, short put, basically it means I'm committing myself to buy the shares at the strike price. If at the end of expiration, which is 21st Feb, the stock closes below the strike price, right? So what I did was I sold the short put at a strike price of 55. So that means I am committing myself. I'm committed that I will have to buy the stock at 55 if on 21st February, the stock closes 1 cent below 55. Even if the stock is at $30, I have to buy it at 55. Okay. That's one leg of the trade. The other leg is the call spread with the strikes of 105 to 115. 105 to 115. Okay. All right. And say I actually own 100 shares of Palantir. I wouldn't do this. I mean, for those who are new, I wouldn't do this if I'm not holding the 100 shares. Let's say I'm holding 100 shares in my portfolio. Okay. All right. Why I did what I did? When I did the trade, the stock was trading at 71.30. Right now, the stock has fallen down to whatever, 60, 66. Okay. So here's the logic why I did it. I sold a short put at 55. Those who think or have been told that options are risky, they're not risky. This is how you can use options to reduce the risk or get a better deal in the market. You just have to figure out how to use the options. This is one example. A short put at 55. Like I said, if the stock stays below 55, I have to buy the stock at 55. And total premium that I got by doing these two combined trade was $2.07. Now the premium has come down. So this is what the premium was.
Hey, Vivek, sorry to interject. So Palantir stock, you can't be called away before the expiration, or can you be then?
It can be called away, but that's what I'm saying. I'm holding a stock.
Okay.
So we'll talk about that. So right now I'm discussing only one side of the stock, which is a short put.
That's right. Okay.
Right. So it means the stock will be assigned to me. Total premium is $2.07. So my cost basis, net cost basis of the buying the stock will be $52.93. Right. $55 is the stock buying price. I already got $2.07 as a premium for doing the trade. My net outgo is $52.93. Fair enough? That is 26% below the $71.30 price. Think it this way. I know Palantir. I've been following Palantir for a long time. I'll tell you, hey, are you willing to buy the stock? If it's stocks that are 25% lower than today, heck yeah. If you think, yeah, you will be willing to buy, makes sense to do this trade, right? It is equivalent to making a commitment to buy Palantir shares if it fall down 26%. And if you're okay with it, I was okay with it. So I did that. Second leg is a call spread, right? So what does a short call do? So call spread means you have a short call, which is 105, means I am obligated to sell the stock if stock closes at 105 or above. I can't tell, okay, I'm assuming that I'm not going to close the trade before it. Even if the stock is at 110, I will have to sell the stock at 105 because I'm selling a call at 105. Right? So that obligates me to sell the stock at $105 at the end of February 21st. Including the premium, the effective sale price would be $107.07 because I got $2.07 as a premium. That is 51% higher than the current price. I'm like, for what? For 40 days? If the stock goes up 50%? Today I know that, hey, it's a overvalued stock at 80. If it goes to 105, if the Reddit crowd comes beyond, behind the stock and push it to 105, I won't feel bad if I can sell 100 shares of it. Right? So I can sell a portion of my Palantir holdings. I did one contract. I own more than 100 shares. You know what? If I'll have to let go 100 shares, it because the stock jumped more than 51%, won't be too bad about it. But what if it doubles? Let's say Roaring Kitty comes onto Palantir and Palantir is sitting at $200. Will I have a seller remorse that I'm out at 105? And this is what keep a lot of people from selling covered call is, oh gosh, I got out sooner because the stock went up like 2x and my share got called away. I've seen this many times. Yeah, maybe that's why I did a spread. So if a stock, I have a long call at 115. If the stock goes to 205, I'm still back in because I can buy the share from the market at 115. That's why I have a long call. That's why I have a call spread. So what if the stock closes at 115? I will lose on an option side. I will lose $7.93. But on the stock side, I would have gained $43.70. Pretty good deal, man. I mean, the net profit will be $35.77 per share. Yeah. And this is like, if the stock is 115, if it continues to go higher, I'm going to make more money. What if the stock doesn't do anything because I've got a such huge window, stays between 55 and 105? What happens then? I'm going to keep this $2.07 that I have received. It's going to be with me. This is equivalent to almost 3.7% of maximum capital that can get blocked. And for me, it's a very little amount of capital. It depends on what's the margin profile you have with your broker. But even if you have very new to options, they'll block the maximum amount of a capital, which will be 5,500, because if the stock falls below 55, you have to honor your commitment of buying shares at 55. So broker need to make sure that you have $5,500, which is 3.7% of max, return. You made $2.07 at an investment of, sorry, $207 at an investment of $5,500. That's like almost 3.7% for 45 days. Not bad at all. Worst situation, if the stock falls down and close way below 55. My break even is $52.97. If a stock closed down below that, yeah, I lose on this one, but I mean, I'm never gonna buy the stock at its bottom price. I know I'm never gonna sell the stock at its highest price. So somewhere I need to figure out, what? Maybe if stock goes down to 50, it's fine. I bought it at $52.97. It's okay. I recently, like I said, I was saying earlier, I've sold some stock at 67 and 60. I'll be able to refill the tank again. Right? So if you know how to use the options the right way, I mean, I don't know where the Palantir stock will go. I have no idea where the Palantir stock will go. Its earnings is coming up, and that is why you can have this can find such a high premium on it. Now, one standard deviation movement is around 85 to whatever 48. So if it falls down and I need to buy at 55 at an effective cost basis of $52.97, I'll buy it. That's the commitment that I'm making. So thought I'll share with you. There was a question on Palantir, and then also, hey, how do you use options to create a trade, and then either is going to reduce my cost basis or will help me to buy the stock at $52.97. And I'm deciding it right now. I don't know whether it'll fall or not. If it goes higher than 105, yeah, maybe I'll be willing to sell 100 shares of it. And right now in many of these tickers, like I think I have another one, IBIT. You have tons of premium in IBIT. If you're in a Bitcoin, I think earlier what Brian was saying, he's you've invested on crypto side. Ever since the options have been enabled on some of these crypto ETFs, I'm doing more on the, when it comes to the crypto side, I'm doing more on the ETF side rather than on the crypto exchange side, because you can get much better premium out there. So let's looking into the crypto economy from the high of 100, and I think 108,000 is what we hit Bitcoin. Now we are up to 94. I know, I think earlier last week or maybe earlier this week, we were at 103K, but it's been vacillating between, let's say, 90 to 105K over for last three weeks. That's been happening. Not too much worried about it. It is what it is. But this week, we also had a happy birthday to the Bitcoin ETFs. So if you recall, spot Bitcoin ETFs were approved and launched, the first one on January 10th, 2024. And then after that, it changed the history of the ETFs. So let's look at that number in terms of how these are performed 1 year after they launch. How big was it? It was a massive, massive win. for these Bitcoin ETFs. Even if you inflation adjust the assets, the 4 of the Bitcoin ETFs are in the top 20 ETF launches of all time. IBIT, FBTC, ARKB, BITB. Top 20 ETFs of all time. We have 4,000 ETFs that trade on US exchanges. The top one, assets at 1 year after launch, top one is IBIT. And look at the performance. Okay, inflation adjusted, that makes more sense. Look at the gap between QQQ and IBIT. It's like almost 50% more asset under management, even if you adjust for inflation. Huge demand. Out of 4,000 ETFs that are currently in US, this is where the Bitcoin related ETFs rank 1 year after the launch. IBIT is number 1. Fidelities is number 4. And then ARKB, BITB is number 18. There are 4,000 ETFs. And with this new administration, I think I'm still more hopeful that we will see a lot more activity in this space. So am I worried about whatever last 7 days, it's down 3.6%? Nah. I mean, this is a volatile asset. And this is why you get paid to go through the volatility. Again, you need to position size it. Because the stock, I mean, I don't think probably it will see 80% drawdown, but I won't be surprised if you get a 50% drawdown. 80% seem far-fetched because now we got a lot of institution money in this one. But 50%, yeah, sure. So let me just do one more. I think I had let's talk about premium liquidity, amount of liquidity in, the amount of insane premium that you can still get on Bitcoin ETFs. If you're bullish in Bitcoin, to do a strangle with short put 10% down. Short put 10% down means you are obligated to buy this ETF if it falls down 10%. And then it did a covered call 20% high. So I'm giving myself a lot more room for error, right? So now the IBIT trading at close to $54. I'm going $5 down at 49, selling a short put. And then I'm going up $9, 63, selling a short call. It's a covered call. Don't do anything short. You're getting $1.46, right? For holding it for 3 weeks, which is almost 2.7% of the current price in holding it for 3 weeks. It's almost like a 1% per week. There's a decent amount of a premium that you can have in this IBIT ETF. I mean, there are other ETFs also. I don't find the liquidity or the volume in other ETFs. So IBIT is my go-to ETF if you want to trade or get exposure onto the Bitcoin without actually trading onto a spot Bitcoin or trying to buy the Bitcoin from a crypto exchange.
Vivek, I'm sorry to divert, but you mentioned liquidity and volume. Do you have any quick rules of thumb that you apply to in any option, any stock option, for adequate liquidity and volume?
So one way I look at this is, of course, it depends from ticker to ticker. So for example, some of the stocks don't trade that well, but that doesn't mean I'm not going to do options against it. Like stocks like Mercado Libre, right? That's the biggest position in my portfolio. Options are not that great, but then I'll go do craft a trade differently. But the way I want to look at it, it's how wide the bid-ask spread is. So if there is enough of volume or liquidity, you will see the bid-ask spread being tight. Now, I bet by default, all the bid-ask spreads are close to 5 cents. I think this is what the market makers want to make at least 5 cents or on opportunity, make them at least 5 cents per trade. But let's say if I'm doing anything related to S&P 500, right? In that case, S&P 500 is one of the highest liquid, I would say the index. If I were to trade options on it, I would rather trade it on SPY, because SPY is highly very tight bid-ask spread. Right now it's off market. Otherwise, these would be maybe close to a cent difference between bid and the ask. Now, there are some guidelines that I had shared in one of the option bootcamp series is, yeah, I want to see, few hundred open interests. Again, that depends from a stock to stock. Right now, look at SPY, open interest is like 36,000. Right? You have a decent amount of open interest, good amount of volume, but majorly I will focus on how tight is the bid-ask spread. Why would I use SPY and not VOO? I think VOO is S&P 500 is just because of the difference between the liquidity. Now the volume is what, 6 contracts? Open interest is 23 contracts. It manifests itself in this wide bid-ask spread, which is like $2. And that's the reason, even though VOO is much cheaper to hold, the expense ratio is very less as compared to SPY. But I don't hold VOO in my portfolio. I mean, I hate paying, fee to the managers, but the reason is because trading options on VOO is very costly because the bid-ask spread is very wide.
Thank you.
Whereas trading options on SPY, I can do hedging, I can do everything, and without paying too much to get in and get out, because the bid-ask spread is a few pennies versus $2 in VOO. So focus on what's the bid-ask spread, how tight the market is. If a market is highly liquid, you will see that these bid-ask spreads are very tight and not too wide. And I hold companies like I talked about Mercado Libre, right? It's a number one. It's a high value stock ticker, and you'll have at least $7, $7 of difference. If you are dealing in a stock ticker which is like $1,000, and look at the volume of this, okay, and the volume is not too high because not many people trade it, you will see these differences. But then you have to be aware of it. And that's why if I'm doing a trade on Mercado Libre, my profit target, profit percent target, I will reduce it. So I don't think I can have the same. Let's say I'm doing an SPY, my target is maybe if I'm making 50 to 60% of max, I will close the trade. When it comes to Mercado Libre or ASML, my target is 30%. I'm like, if I'm making 30% of max what I can, I will close the trade. So you adjust your other parameters to compensate for the lack of liquidity. Now, if I was not holding, let's say ASML or Mercado Libre, I won't do option trade just on it because it's not really worth. I'm doing it right now because I hold the stock and I want to reduce the cost basis. That's what I'm doing. Hope that helps. I like
Yes,
NVIDIA. Sure.
Thank you.
All right, you're welcome. It says, I like NVIDIA in terms of volume and spread. Yeah, NVIDIA is like one of the most traded tickers, right? If you just want to do options, you don't want to hold stock, NVIDIA, Tesla, these are highly traded tickers from an options perspective. These typically are always on the top of most traded option contracts when you talk of individual stocks. Of course, I think when you look across, it'll be some of the index or index ETF that will be most traded. But when it comes to individual stocks, Barring the case when suddenly Carvana blows up or another company blows up, Tesla, Nvidia, Apple, they are generally in the top 10 of option contracts traded for individual stocks. The reason why I brought up this topic is many of you have been hearing about there is something called Bitcoin, but I don't know about crypto. I don't want to open another account in another one. Now you can get economic exposure to Bitcoin through your brokerage firm, because now there are ETFs available. And if you are still feeling jittery, you can use options to buy it at a cheaper price than what it is trading in the market, or try to buy it at a discount when it is trading in the market. Right? And right now the premium is high. I'm sure if it becomes mainstream, you're not gonna get the similar amount of premium. If the volatility starts to come down, you're not gonna get the same amount of premium. But right now I'm enjoying it. Right? So I think I was sharing, was it last week or maybe I was sharing with a group of friends. These ETFs have been around for 7 weeks, and I've already been able to reduce my cost basis by almost 7% of IBIT. Right? Now, it's not going to stay this, you're not going to get this insane amount of premium for next 2 years. But if we did, in 2 years, I've recovered everything, what I've invested in it. Right? Then it's just the house money. And I still have all the shares that I hold in my portfolio. Won't that be great? It's like someone gifted me these shares with a zero cost basis. Then it becomes much easier if the Bitcoin falls down 25%, if this ETF falls down 25%. Hey, I got it for free anyway. In this case, not really free, but I forced the market to continuously pay me the premium, which kept on reducing the amount of dollars that I've invested behind this IBIT. Yeah. So this is where the power of option lies if you use it for the right way, to reduce the risk in your portfolio, to hedge your portfolio, to buy the shares at a better price than what it is trading in the market. And if stock doesn't go to your price that you want to buy, you get paid for waiting. I mean, time is money. You get paid for it, right? So anyway, let's talk about, I'll skip this zombie chain. Let's talk about Carvana. There's a short report on Carvana. What does Carvana do? Let me ask you a question. What does Carvana do? They sell used car, I understand. How do they make money? And I think I talked about it in 2022. But of course, many of you were not in these sessions. Financing, exactly. So the business model of Carvana is this. They buy used car, they sell used car. They have a vending machine for cars. Yes, you can put in a token and the car will roll down. Of course, it'll come down in an elevator, and that's what they're famous for, is to have this vending machine. I think I saw one in Fremont or somewhere. So look at Carvana, Carvana, vending machines. Oh wow, they got a vending machine locations. So these are the big vending machines. You can go and put your token, and then let's see. Oh wow, there are many out here. Daily City has got one. So and the car will come out of that vending machine. So they're in a business of selling used cars, but what they do is they make their money when you finance, take a financing option when you are, buying a car. So the stock was darling of the markets in 2021. That's where it came on the radar of a lot of investors, retail investors. Let's go back to around here, right? And why? After 2020, and why did it jump so high? Because let's say the car loans, etc., whatever, 6%, etc. So when Carvana sells you the car, you take financing from Carvana. What they used to do, it's your asset-based securitization. They will basically sell these loans just like your mortgage company. They will sell these loans to other investors, Wall Street investors, those who are looking to invest in alternative investment opportunities, and they will immediately sell those loans to those investors. So that's where they made money. So they don't have any risk on their balance sheet. Let's say you're paying 6%. There are investors who are willing to buy those 6% interest income, stream of interest income, because in the market in 2020, interest rates were 0. So you have to hunt for yield. Now, if you are a fixed income, coming back to fund manager, hey, you could have invested in a stock market in an ETF. They were doing pretty good. But if you're a fixed income fund manager, you can't invest in an equity. You are looking and hunting for a fixed income opportunities. Which one of the credit opportunities are, I can buy a loan from you because, hey, this combination of loans, the customers are paying 6%. Now, depending on a credit score, etc., there will be different tranches of these loans. So essentially, what they used to do, all the money that they'll make through the financing. The amount of money that they make in a car was very less. I'm not saying they didn't make anything, but that was a minuscule as compared to what they made in financing. What happened to the stock in 2022? Fed start to increase the interest rate. Now those investors thinking, dude, now I can make 4% risk-free. Why don't you take a risk of the end customer not paying it and for 5%? At the end of the day, if you buy a loan, you buy a bunch of loans from Carvana, some of the customers may not pay because of all, stuff happens in the life. You thought you bought a car, everything looks good, 2021, companies are hiring. If you're a tech employee, you're like a king. And in 2022, companies start to lay off, stuff happens. And then, what, I'm not going to pay for the loan. And some of them won't pay it. So there is a risk. And if you're only getting 5%, I'm not interested. I can make 4%, 4.5%, 5% in treasury notes. So the demand for these loans fell through the bottom. And hence we saw the stock price crashed. And now what is fancied, everyone is surprised, like, hey, the rates are still high. How come the stock price has gone up so much? How come the stock price has recovered? And it was surprising for me as well, because we've seen Carvana like 20 in single digit. At some point of time, it was like $3.55. And then at the highest, it was what, 267 in the recent high. So there were a lot of questions around what is happening here. How is Carvana being able to perform so well? Right? So something must be happening which we are not able to figure out. So, but this is essentially their business model is. So what is the short report talks about Carvana? At the high end, it's a story of a business, Carvana, owned by Mr. Garcia, and another company called Drive Time, owned by his dad, called his Senior Garcia. Okay, and there are other allegations around, accounting stuff and how they have moved around, or the games that the management has played to keep the stock price so high. So let's go through it. I'm not going to read through everything. The overall report is much longer. These are just the bullet points at the start of a report. If you're really interested in it, go to I think it's the Hindenberg report, and they generally do a good job. And Hindenburg Carvana, it's It's a very long. So these are the bullet points that I just put in there, but it's a very long report. It's interesting, details of what could be happening. So Carvana is at $44 billion. Its main business is online platform that allows retail customer to buy and sell used cars. You got it right. They sell used cars. It was facing bankruptcy risk in 2022, 2023. Stocks spiked 284% in 2024. And that's what everyone got interested. What Hindenburg found out was $800 million in loan sales to an undisclosed related party. So this is like an accounting, it's an SEC, it's a violation of SEC rules. If you are dealing with any related parties, and the law is clear in terms of what the related party is, you have to disclose it. They never disclosed it, that it's a related party. And since all their valuation and the profits are coming from loans, selling $800 million loans, an undisclosed related party, along with the details of accounting manipulation and lax underwriting, has fueled this growth, while insiders are cashing out billions in stocks. If the future is so great, why is the CEO and CEO dad are selling Carvana stock? And why are you buying it if they are selling? Skin in the game. In this case, doesn't look like that the management is with us. They've been selling their stock. Anyway, Carvana business already faces major headwinds. Used vehicle prices have declined 20% over past 3 years, right? Previously, the Carvana CEO's father, Ernest Garcia, sold 3.6 billion in August during the last peak. Remember this peak? During this cycle, he sold $3.6 billion. Now in the current cycle, he has sold another $1.4 billion. Well, this number is somewhere there. So that's one thing. The insiders have been selling. Number two, Carvana has relied on purchase commitment with Ally Financial. So Ally was a spin-off of GM. So GM had a financing arm which they had used to give loans to customers who wanted to buy GM cars. I think during the restructuring after the whole 2008 crisis, they spun it out. That became Ally. Now Ally Bank, Ally Financials. It's a big in auto financing. So Carvana has a commitment from Ally Financial, and almost a huge amount of loans that they originate are bought by Ally Financial. Analysts have been asking, and Carvana has been telling the market that we're going to find another partner, because 60% of your business happens through one company. There's a customer concentration risk. What if Ally says no more? Then you're toast, right? So this is called customer concentration risk. But over the past 6 years, they haven't been able to diversify outside of relationship with Ally. For 6 years ago, they've been telling that we will find another partner. They tried to reach out to Wells Fargo, and Wells Fargo told them, the Hindenburg guys, as we dug into it, the more we learned, the less we liked about this company, because how they are underwriting the loans. There are almost no due diligence in terms of when they're giving the loans and how the loan is being serviced. Right? And one Ally executive told us we pulled back from them pretty significantly in 2024. And now the commitment extends only till Jan 2025. Right? So let's say we stopped doing, or we lowered the amount of business that we do with Carvana in 2024. And the current extension that we have with them, commitment is only till Jan 2025. So Carvana really need someone else to buy the loans. But that's how they show the profit. So what they figured out? They found out another company to which they sold $800 million. Now, when Wells Fargo told we don't want it because we don't like the business practices, who is another company that suddenly bought from them? It's a company it's a trust which is affiliated with Cerberus Capital. That's fine. Maybe Cerberus Capital did their due diligence and found that Carvana is a great business and I can make money off these loans. But hold on. This is a company which is owned, whose chairman is one of the directors of Carvana. So this is where it called as the related party transactions. Right? Maybe I'll take a loss on Cerberus Capital, but I have a shares of Carvana. Maybe I'll make profit over there. You have to disclose these related party transactions in your filings. And they didn't disclose that it is a related party transaction. So what else? Now, these asset-based securitization that they do, right? 80% of these loans that they do are on deep subprime range in terms of the FICO scores. They're very high risky loans. And that's why Carvana says, the risk is not onto us. We've already moved it off our balance sheet. We sold it to someone else. But if we really look at that, there was somewhere the data is that they are still owning a few $100 million of a loan on their balance sheet. And they have not been able to offload everything. And as a good accounting practice or good financial practice, would assume that you will keep some reserve on your books to account for any losses from these loans, right? Because these loans are being taken by individuals who have a very low FICO score and they will default. So you need to keep some money aside as a reserve to account for that loss. But Carvana does not keep any money aside. Very aggressive accounting, because if they keep the money aside, then they can't show, their profits will go down. So that's another topic that this report has talked about. Third one the report has talked about is a related party accounting gains, one that we already looked at with the Cerberus Capital. Another one is who service their loans. It's a private car dealership, Drive Time. It's an affiliate of a Drive Time, which is owned by the CEO's dad. Right? So the loan is serviced by a company affiliated by Drive Time, which is owned by the CEO's dad. And this Drive Time company is private. They don't have to report their profit and loss to public. So what's happening is they'll push out the loans to these Drive Time. The loans will default. It's a Drive Time will have an issue, but anyway, they are not a public company. They don't have to report. And the senior Garcia, who owns a chunk of Carvana stocks, even if his private company make losses, he has made more money than what he lost in a private company in the stock price of Carvana. Because you are able to show that as a revenue of Carvana, your revenue jumps up, your stock price is high, and he's been selling his Carvana stock. So Carvana is dumping the cost of, and of course there are extended warranties and all that cost. There are multiple ways in which the cost is moving out of Carvana's financial statements onto the Drive Time statements. So this reminded me of the stuff that Enron had done. So the CFO of Enron had created a bunch of other companies they used to call as Raptors, right? In which whenever there is a quarterly reporting time, Enron used to do these balance sheet transfers from, assets moving from its own balance sheet over to those Raptors. And, hey, those companies had taken away these things from us, and those are off my balance sheet. And then Enron was able to show its financial health in a pretty good picture. Something similar happening here. So they're using Drive Time to put everything that is toxic into the Drive Time. And Drive Time is not a public company. And the CEO of Drive Time, if it was not the Carvana CEO dad, he would question, why should I take, crap from you? But he's okay to take crap because he's making money in a Carvana stock. So they are basically having a sham deals with Drive Time. Again, these are alleged This is what Hindenburg is alleging, and Hindenburg generally does a good job. A former Carvana director responsible for inventory told us selling cars to drive time is a lever that's not talked about. It's like a fight club. There's certain things that we don't talk about. We don't talk about drive time. And if your cars are not selling, they're sitting on your books, you sell it to drive time. Drive time will pick it up at loss. That's okay. Because CEO's father is making a lot of money anyway. And who is other thing? Sketchy related parties are enabled by conflicted board members. The independent audit committee has 2 individuals that also serve on a board of drive time. So the corruption is there even at the top on the board member level. One independent member of audit committee was previously suspended by New York Stock Exchange because there were some impropriety stuff that this board member had done with the CEO's father, and now they are both together again. Carvana CEO father, the key shareholder dumping billions in stock, has pled guilty to bank fraud over fake accounting income through sham transactions. So previously, right? This is not related to, I think, the Carvana stuff, but in his own company. Carvana CEO said, we don't end up taking credit risk over extended period of time. This is where they say, we don't keep stuff on our balance sheet. But yes, the loan held on balance sheets have increased 50% till 2020, since 2021. And there is no reserves for this. I think that's a key stuff around. The other one is Carvana reported a profit of almost $3,500 per unit, means per car that I sell, how much gross profit do I earn? Carvana reports that it earned $3,500. What Hindenburg claims that this metric is inflated by at least 35% because some of the $390 million of expenses, they've miscategorized it as selling and SG&A expenses and not as a cost of sale, which the rest of the industry does. So they're saying, come on, you miscategorize that expense and hence your gross profit is up by 35%. Right. Finally, there is an undisclosed SEC investigation going on with the firm, and the company doesn't clarify to the market what is happening with that investigations. Right. So overall, we think Garcia's will leave shareholders with nothing. At any point in Carvana's 2 incredible stock runs, it could have significantly raised capital, de-risk its balance sheet. Yeah, the stock is like so high. They could have sold stock, but that would have brought down the stock price. And then how senior Garcia will be able to sell it? Instead, the company has pushed off creditors and engaged in accounting games while the CEO father dumps billions in stock. We think Carvana is truly an accounting grift for the ages. We see rough times ahead for both the stockholders and bondholders. So if you're invested in Carvana, you should go ahead and read the details of this report. Again, these are all alleged. I don't know how much truth is in this, but generally Hindenburg does a good job of getting deep into the details of the business. They talk to other parties to figure out, what's actually happening here. So pretty damn report for Carvana. Right? Now, I don't know what will happen to the stock price. People still want to buy it, they'll buy it. Haters will hate and degens will buy, I'll let them buy it. But I am not touching this business because the business of just making money by selling financing or selling the loan securitization. We burnt ourselves in 2008 by securitization around mortgage bonds. Nobody understood what you're packaging and selling. Similarly, no, I don't know. I can't understand what they are packaging and how they are selling it. But this reports talk about a lot of other irregularities that I would, stay away from this. How do we check the authenticity of the information in the report, which is not in public domain? I mean, there's a lot of information. Either you have to do your own research, like Hindenberg has done the research. They've spoken and talked to the employees, to the other companies, etc. And maybe there are some others. There is another pension fund that has sued Carvana because of some other impropriety. So you can look at those code documents. I mean, there are a lot of screenshots in this overall big report. You can look at who the chairman is. You can Google about Greg Sullivan and Google to see, if he was sanctioned by New York Stock Exchange or not. I mean, that he was suspended by New York Stock Exchange or not. You can Google all this. Oh, actually, it looks like there is a code document also has this. So yeah, you can go through the detailed report and see. Some of the information is from, the majority of the information is from public documents. And then they are done their interviews, etc. All right. So I think, yeah, let's call it a day for today. Whatever the other stuff we can cover in the next week. I can hang around for some questions. I think by default, I moved the meeting to 2 or 30 minutes because it generally always moves in here. So I thought, let's keep the meeting itself for 2 or 30 minutes. But I can hang around for another 5-10 minutes. Any questions? Anything else in your mind? What new thing you guys are learning? Hey, other thing. There are 2 more short reports that I've yet to go through it. You tell me which one you are more interested in. If you are interested in none, then I won't bore you next week. But if you're interested in any one of these, do tell me which one do you want me to present. I'll probably spend time in going through both of them anyway. There's a lot of stuff to learn from short reports, and I love reading through those. Transmedics or app loving? Any takers? Nope. All righty.
AppLovin. I would prefer AppLovin.
Yeah, I mean, we want to talk about other things also, right? AppLovin. I think a lot of people love AppLovin. So let's do AppLovin. I don't own AppLovin. I do own Transmedics. If you recall, that was the other ticker that I added in 2024. Like dip my feet position. I'm not selling it. I've yet to go through. It's like a 300-page report. At the outset, looks to be a very job of very junior person, because after reading through many of Hindenburg reports, when you look at, I think this was a Scorpion Capital. I never heard of this name before. I'm like, looks. I mean, that report was at an outset looks to be trying to generate a lot more emotive response than just presenting of facts. But I have yet to go through it. I'll go through Transmedics. Okay, I'll bring AppLovin. Let's do one. Other question I have is, maybe if you have more people, I was just thinking, maybe should we create a breakout room? And if you guys want to talk about, let's say, some topics, maybe there are someone of you who are interested only in crypto, and like, what the heck, you're talking about all the TradFi. I'm a DeFi guy. So if you want to get into a breakout room to talk about crypto only with some other like-minded people, do let me know. I can create a breakout room. You can go and have your own discussion around DeFi. Or if you are just new investor and say, I don't understand all this, what option stuff you're talking about, or all this compounding, but I'm a very beginner. I want to talk about very beginner talk for 5-10 minutes. Maybe we start our session with the breakout rooms. Do let me know what you think. I just want to make sure that this is as useful, these 2 hours is useful to you. And if we have more people joining in, then obviously some will be interested in A topic, some will be in B topic, some will be interested in XYZ topic. I just want to make sure that you don't feel like, oh, my time got wasted because I am interested in only one topic and then I had to look through so many stuff. Stock and option screen. Yeah, I mean, yeah, we could have a breakout room where like, hey, let's look at the screeners. Different screeners. Yeah, something that I was thinking about it today morning. Maybe we can do it for next time. What else? Anything else in your mind? All good? Cool. All right, I guess that's it for today. Thank you everyone for joining and spending 2 hours, almost 40 minutes with me, and grateful to you. You guys have been doing it for almost now 5 years and running. Let's continue this trend. Markets will go wherever it goes, up or down. Who cares? We are here for the long term. In the long run, I mean, it'll work out just fine. We don't have to do anything stupid. Cool. Signing off. Thanks, guys. And we'll talk to you again next week. Bye-bye. You're welcome, guys. Okay.